Started. Hello and welcome everyone for joining us to our weekly crypto journey session. Thank you so much for tuning in. We are hosting this talk every Thursday during your lunch hour, so you can join our crypto talk while you're having your lunch break. First, let me introduce myself to some of our new attendees. I'm Merlinda, one of the team member here at DASSET, and I will be your moderator for our weekly crypto journey talk. Each week, we will be doing a presentation for our chosen topic of the week, followed by a hands-on demo so that you can get better navigate around the world of crypto. And before I introduce our speaker for today, I want to let everyone know if you miss any part of this crypto talk or would like to hear this session again, there will be a recorded version of this talk available by request. Also, would love to hear from you. Feel free to post a question or even an opinion or say hi by clicking on the Q&A box below or the chat box as well, and I'll make sure that we get the question to Stephen at the end of this. And without giving too much away for today's topic, I will send it away to Stephen.
Thanks, Merlinda, and thank you everyone for being here. Today's topic is stablecoins, and stablecoins are a very controversial topic from a number of different entities, and so we're going to look at them from various angles, from their history to their regulatory implications and where we're going with them. And if you're not aware, DASSET is New Zealand's trading platform for digital assets. We have over 80 assets on our platform, with a few that was just added this week, which we'll be posting on social media. So stablecoin. Now, the first problem with stablecoin is we don't even have an industry definition that is recognized by everyone. There is controversy across the board. For example, there was a recent report by a US regulatory agency, and I believe it was the SEC, and don't quote me on that, but if you look at the paper, they had stable in quotes for the entire paper, and they were definitely implying that stable coins were in fact actually stable. So let's go over, I guess, what the two primary definitions of what a stable coin is. They are usually a digital token that is pegged to a specific underlying asset. Now, initially, that asset was a national currency, and but today you'll find digital tokens that are pegged to other assets like gold, or pegged to things like Bitcoin, like wrapped Bitcoin. Now, that is where we start wondering exactly what is the stable side of a stable coin. Now, the other thing to keep in mind is that the stable coin is free floating. So a stable coin where one digital token represents $1, in theory, it might have a discounted or premium price. So although it is meant to equal $1, if you look on the market, it might have a price of 99 cents, or it might have a price of $1.01, and we'll go into why. So are they considered stable because of the peg where the digital token represents that underlying asset, and you know, it's relatively stable to that underlying asset? Or is it stable because it's pegged to a low volatility asset like a national currency? And so this is where I think it's a little bit up for debate, because there are digital tokens that represent crypto assets like Bitcoin and Ethereum, and they could potentially be considered Stablecoins because they are pegged to that asset, relatively stable to that asset. However, Bitcoin, as we know, is not very stable when we look at national currencies, and that is also up for debate. When we look at something like the British pound during Brexit, the British pound during that year was more volatile than Bitcoin, and so it's very debatable as to when we start looking at volatility and start comparing crypto assets to other assets like stocks or foreign currencies. Now, in theory, a very large trillion-dollar foreign currency like the US dollar tends to be more stable than other foreign currencies, tends to be more stable than other assets. But that's not always the case. And we're starting to see a lot more volatility in currency markets, especially around things like the US dollar and New Zealand dollar recently over the last couple months, or between the US dollar and euro. And so, this is where there's a little bit of complication and confusion trying to understand exactly what stable means. But when we look at the mechanics of how they work, they do work in two, potentially three very different ways. And they have different risks. And so the traditional stablecoin, I shouldn't really say traditional because stablecoins came out around the same time with both mechanics. And so the one that's most well known globally and is also the most contentious, the most talked about, the most used is Tether. And that is US dollar Tether. So it is one Tether equals or represents one US dollar. And that would be considered an analog asset-backed stablecoin, in that it is backed by assets in the real world. So you assume that for every digital Tether token, there is one piece of paper held in a bank that represents $1. Or, banks don't actually have huge amounts of paper sitting around. It's now all ones and zeros, but the bank in theory has a digital representation of $1 that represents the digital token Tether. And so this adds layers of institutional risk, because first you have the entity that is issuing the token, or managing the smart contract, and they are also managing the assets underlying that stablecoin. In addition to that, they usually have to rely on additional entities. They have to rely on banks. They have to rely on having a legal entity. So they have jurisdictional concerns and custodial concerns. And so this is where it becomes really interesting when we start looking at the history of stablecoins. And so the risks for analog asset-backed stablecoins are institutional. So you have to rely on those institutions, and regulatory, because these institutions have to be in jurisdictions that are heavily regulated. Then on the digital side, we have the other form of a stablecoin. This is often called an algorithmic stablecoin, and there are different mechanics. So algorithmic stablecoins can work in a few different ways. I did kind of classify them all in just one, where you can actually have an algorithmic stablecoin that's not backed by any assets, but we'll talk primarily around the ones that are backed by assets, but those assets are digital. So they might be backed by Ethereum. And so the risk there is not that it's backed by Ethereum, but that the software that is managing that collateral is sound. that there's no way to exploit the software to extract the funds that are being held in escrow. So that's a risk. So you have to essentially trust that smart contract. Something else isn't mentioned here, but making sure that the actual stable coins are fully collateralized, which really comes down to the software risk as well, which I'll go into. And so that peg is managed by computers. So, you have to trust computers, but there are a number of them that because they are because they exist in the digital realm, the legal entities that are helping them could disappear, but the stable coin isn't going to go anywhere. And so you can go after those legal entities, but somebody in a completely another country can still use those that software to use or create or trade or utilize the digital asset-backed stablecoin, and so they have less issues on the regulatory side of things. And so looking at going a little bit deeper, the analog asset-backed tokens, they tend to be backed by the asset that they represent. So a dollar in the digital world is meant to be backed by a dollar in the physical world. However, the problem is the magnitude and size at which these stable coins are growing. And so it's not that easy. If you think about a stable coin, an entity that's issuing a stable coin, they have to make money themselves. And so they usually make money from things like interest. And so initially, if they were managing, $1 million or a few $1 million in stable coins, that means they have a few $1 million at a bank. They might be earning 0.5%, whatever they negotiate with that bank. But once they start growing and getting to economies of scale, they start holding billions and billions, tens of billions of dollars. That becomes very difficult managing risk, because not only do you have to trust the banks the funds are at, the banks have to lend out those dollars to earn that interest. Interest rates are approaching zero globally or going negative, so there are issues there. And so they're essentially forced to diversify, very much like a bank is diversifying. A bank only holds 3 to 7% of your dollars in dollars and the rest of it in other assets. And so by necessity, they are forced to hold other assets other than the fiat asset. So those assets might be if you look at the money supply, you have the M1, M2, M3, and so they might be less liquid forms of cash, like term deposits or CDs, which you might call in other countries. You might have to hold commodities like gold. You might have to hold bonds. Bonds are a very popular one. Ideally, and at least ideally from their perspective, it's considered lower risk to hold government issued bonds. But again, you have to ask, are they actually low risk? And then equity. And so if you look at the portfolios of these very large stable coins, it's not necessarily backed one for one for the fiat asset that it's meant to. And so at the end of the day, some of these entities have gotten so large that people have removed the idea that they have to be backed one for one. And just like a national currency, like the New Zealand dollar has value because we put faith in it having value. So I think that's a very important consideration when we look at these stable coins, is that you could potentially have a stable coin that's backed by nothing. And this is just, potential, just theorizing, but you could have a stable coin that's backed by no other physical or digital asset, and it has that peg because people believe it has that peg. Sound familiar? That's exactly what the dollar is. And so when we look at a digital asset backed stablecoin, they tend to be over collateralized. So if you're holding analog asset backed, then for every dollar you deposit in the bank, they'll mint you one digital dollar. But asset backed, you tend to have to put in more than $1. So you might have to put in, so initially when they first started, for every dollar digital stablecoin that you wanted, you'd have to put in $2 in collateral. So you'd essentially have to over collateralize by 100%. And so that means that the asset would have to drop by 50% for it to become uncollateralized. And so that was a way to create a little bit more assurance, but there are some major problems here, at least for a number of stable coins that have attempted to do this. And specifically, the biggest issue is in the event of a black swan. In the event that an asset price starts dropping, to give us a tangible example, the most popular asset-backed stablecoin, digital asset-backed stablecoin is DAI, D-A-I, and one DAI is representative of $1 US, and it is it was initially backed by Ethereum, and so for every one DAI, or which represents $1, you'd have $2 in Ethereum. Now, if Ethereum started dropping, if it dropped 50% in price, then what the network would do would sell your Ethereum for the dollars, underlying dollars essentially, so that it remains fully or over collateralized. And so the tricky thing is this is all done on chain. So it's all done on a blockchain network. And there are not only scalability issues, well, I mean, that's what it comes down to, scalability issues. How many transactions per second can happen on this network? So in the event Ethereum drops 50% in 2 seconds, which is very unlikely, but is very possible when we look at things like March of 2020. So in the event that Ethereum or an asset has a major drop in value, that will trigger this software to start liquidating those assets. Now, that means it has to liquidate those assets on chain. So it's putting a lot of transaction throughput on chain. That means that they may not execute in time. That means they have to increase the fees, the transaction fees on the network all at the same time. And they have to do it in time. If they don't liquidate those assets in time, then the entire protocol becomes under collateralized. And then the other thing is the cascading. If the network is so big that it starts liquidating Ethereum, it could essentially make the issue worse, where they have to sell Ethereum, which is pushing the price of Ethereum down, which could force more sell-offs in Ethereum, which is pushing the price down. So it creates this cascading event where a few protocols in the early days were under collateralized because of these major drops in price. And so I'm just going to go over 2 of the most well-known and biggest stable coins and kind of go into detail, their history, their mechanics. So, and also go through, so you have a little bit of understanding, because there's a lot of misinformation out there from a number of different entities. And I think it really comes down to not understanding the industry, the space, the history, and what's been happening in crypto space. So let's take a step back to 2012. 2012, you wouldn't find a bank that would service a crypto business anywhere in the world, with maybe a few exceptions. But it was extremely difficult to bank a crypto business in 2012, virtually impossible. And so when you had to buy Bitcoin, you had to buy it on PayPal, you had to do it person to person. There was one exchange in Japan, Mt. Gox, and everything else was crypto to crypto. So getting into the crypto space was a huge barrier to entry, huge risk, very dangerous for everyone involved. But once you were in, you could go to a crypto exchange. There were many, and then you could trade one crypto for another, and it was very easy. So it's kind of like DASSET, but without that New Zealand dollar on-ramp off-ramp. So there was Cryptsy, there was Poloniex, there was Bittrex. There were a number of crypto to crypto only exchanges. And what Tether enabled, so Tether came along in 2014, and they solved the banking problem for most exchanges. So that enabled people around the world, exchanges around the world, to allow people to trade crypto assets against a national currency. And so the most well-known national currency is Tether, and it's going to be very difficult for other national currencies to compete on the level as Tether. And so it's I think really important to realize that it's even exchanges like Binance wouldn't be where they are today without Tether, because Binance had no USD markets. They didn't have any banking. It took years before a company like Binance got banking. And so Binance, the largest exchanges in the world between 2014 and maybe 2018, 2019, relied on Tether to operate and provide customers a service, because what it enabled customers to do is have a something that they can relate to. Everyone can relate to their national currency. Everyone can relate to dollars. You know, when you go to a grocery store, you can wrap your head around what's expensive, what's not, because you've grown up with dollars all your life. And so it's very easy to relate to Bitcoin to something that you know, which are dollars. And so by being able to take profit in dollars, or to buy an asset in dollars or trade that asset, made it very easy to access this market. But you couldn't do that with a bank transfer. And the reason why is banks, if you were an individual, would shut down your bank account. If you're a business, wouldn't even let you start create a bank account. And so as this barrier to entry, Tether solved this. But the problem is they didn't solve this by being transparent. They solved this by hiding information. And that was their secret sauce. So they essentially went to a bank. They opened up a business without a business bank account, without informing that bank what they were doing. And so the bank was quite happy to accept a new business and didn't realize that it was a crypto business. So that was one thing that they did. So they were very gray in terms of their transparency, and they had to. If they told the bank what they were doing, their bank accounts would shut down. And so they at least managed to get their foot in the door. They managed to do that by calling 10 to 20 banks a day, every day around the world. And they're essentially opening bank accounts as quickly as they were getting shut down. And so it had to be not very transparent about their banking relationships and how they were operating on that side of things. And so that is where people started asking questions and started having concerns, because it wasn't very easy for them to get an audit from one of the big four. And even one of the big four all said, Tether's too high risk for us to audit, so we're staying away from it. And so they've had a lot of difficulty trying to legitimize themselves. However, what they've done for the industry has been absolutely incredible in terms of enabling the crypto industry to mature in a gray market without the proper regulations in place, without the proper understanding behind the industry. So Binance wouldn't be where it is today if they weren't able to offer Tether. And from a regulatory perspective, if regulators were really unhappy with crypto, they could have squashed the industry, or at least stopped at least 5 to 10 years of development if they had gone after Tether in 2015, 2016. But they really missed that opportunity if that's what they wanted to go for. And so there's been a number of allegations around Tether, and the first allegation I think is a little bit more warranted than the other allegation. And so the first allegation that I think is a little bit more warranted but misunderstood is that Tether is being used to manipulate the price of Bitcoin. So this is something that you might have heard back in 2017, 2018. People were trying to find data, and basically what they were saying was the issuers of Tether were minting lots of Tether that weren't backed by dollars. That's the other allegation, but we'll just focus on this one. And then using these minted Tether coins or tokens to buy lots of Bitcoin in exchange and pump the price up. And then when everyone jumped on board, then they could sell and profit and exit. And so this one, is difficult to prove. It's difficult to counter. And there's, this is something that's been held over the head for a long time. However, when you start digging into the data, when you start looking at how Tether operates, and when you look at the regulatory charges and accusations, you'll find that there's really no evidence to show that Tether manipulated crypto prices. And so you'll see, Wall Street Journal has a great hit piece on Tether, actually a few different hit pieces on Tether and allegations. But if you look at legal entities like the SEC, the Federal Reserve, the CFTC, none of them have charged Tether for manipulating prices. None of them have publicly stated that Tether is manipulating prices. The reason why is that when you look at the data, there really is no proof. And but you can kind of understand why people might target Tether for those reasons. What I think is something so I think that one is potentially more valid than the second one. And the second one is Tether is not backed one for the dollar. And I think you have to understand Tether's history. So when Tether was first issued, it was backed one for US dollars. And the problem is in 2017, their partner their company that was like their sister company was using a custodian, and that custodian had $850 million taken from it by law enforcement. So essentially, the regulators in the US went after this custodian for allegations like misusing customer funds and money laundering allegations. And so what ended up happening was the US government confiscated $850 million from Bitfinex, which essentially made Bitfinex under collateralized, which means that it wasn't holding its customers' assets as it said it was. And so Bitfinex had to do something. And so what they essentially ended up doing was getting a loan from Tether and used equity in Bitfinex as collateral. So Tether immediately no longer became backed one for one, where each digital token represented $1 at Tether. So each digital token had a value represented at $1 each, but it was no longer actually $1. So after that, the charges started coming against Tether for not being backed one for one. But that changed two things. Tether started diversifying. So if you look at their portfolio, they'll break it down, and they hold bonds, they hold equity, they hold dollars, they hold CDs, they hold a lot more assets than just dollars now. So this process forced Tether to become a little bit more transparent about the assets that are the physical assets that are backing Tether, and ended up in two charges, which the first one was by the New York Attorney General's office, where Tether stated they did no wrongdoing and they paid a fine for $18.5 million. And then the other one, which was settled this month, and they paid CFTC $41 million for not being backed. But I think it's a bit disingenuous that these allegations and these attacks on Tether are very disingenuous. And the reason why I say that is, first, a government entity stole or confiscated $850 million from these entities, and then they said that they were short $850 million. And so yes, they were not backed one for one for a period of time, and they were attacked for that. But the people who were attacking them for that were the ones that confiscated the assets that made them not backed one for one. And it's unlikely that Tether will ever see the $850 million that was confiscated from them in the first place. So I do think that there's a lot to be said around the events that have unfolded, and asking who's been doing the wrongdoings. And if you look from Bitfinex's and Tether side, they've remained extremely innovative. They've attempted to follow the rules. They've attempted to do all the right things to make their customers whole. And they've done such a good job that, and I shouldn't really say this because, I'm no supporter of Tether myself. But if you look at it from, I think, an unbiased perspective, they've managed to, despite all the allegations, despite enormous amount of controversy, to maintain a peg that's relative to the US dollar, to be used more than any other stablecoin globally, and it's the fourth largest crypto in the world. And so, from all those aspects, Tether is doing exceptionally well. But there are major systemic issues with Tether. The first one is regulatory. So in the US, they don't really know what the definition of a stable coin is. They're trying to identify where it fits, who the regulator should be. And different countries are looking at it differently. For example, in Australia, stable coins are looked at more as derivatives. And so it's very difficult to issue a stable coin in Australia compared to other countries. In the US, there's battle between the regulatory agencies. So at the SEC is trying to oversee stable coins, but so is CFTC, so is the central bank. And so that's being worked out. And so there's a lot of it's going to take some time before we work some of that out. And when we look at the US, the Treasury Department is also looking at overseeing stablecoins. And there are a lot of statements that the Treasury Department may require the licensing or the stamp of approval for a stablecoin. Now, Tether's biggest competitor is USDC, US dollar coin, which is issued in the US by, it's a joint venture by Circle and Coinbase. And they are doing everything by the book. So they're using US banks as custodians. They're engaging with the regulators. They are trying to go above and beyond on every level around their token. And so when we look at the regulatory risks and perspective of the industry, it's a lot more likely that the Treasury in the US, the Treasury Department, will approve USDC. It's very, very unlikely that they would approve Tether because of its history, because its involvement has been primarily outside the US. And so with it being inside the US makes it a little bit more of an opportunity for USDC, which is Tether's competitor. And so, so there are some regulatory issues, and if you asked me 2 years ago, they were systemic. They would be systemic across the crypto industry, where a major impact to Tether would impact the entire industry in a big way. Something else to point out, which was really interesting, you don't really see it nowadays, but in 2015, 2016, you could see arbitrage between fiat trading pairs with Bitcoin and stablecoin trading pairs with Bitcoin. So if you think about dollars, you can only deposit funds into an exchange when the banks are operating. So that's Monday through Friday, 9 a.m. to 5 p.m. So you can only deposit certain amount of dollars in that time. On the weekends, you can't deposit funds into exchanges. So whatever is trading on an exchange, whatever fiat currency is there, is what would be traded. And so the what Tether enabled was reducing arbitrage, or there were arbitrage opportunities, and it essentially enabled jurisdictional or banking arbitrage, where after 5 p.m. on Friday, if there was a large price movement between different exchanges, Tether enabled the price equilibrium between those exchanges for crypto assets. So Bitcoin in Japan would be trading at the same price as Bitcoin in Europe, as the same price as Bitcoin in the US, which you couldn't really find for any other asset at any point in time until Tether came along, because after banks shut down. You couldn't deposit dollars, you couldn't move dollars around, and so you wouldn't be able to so you'd see huge price discrepancies. But Tether helped mitigate that to create a global spot price that was relatively the same everywhere else in the world. And so there's some huge opportunities and advantages. But now the market has established that if Tether went down, it would impact the crypto industry. It would have a relatively large impact, but it wouldn't be devastating. It wouldn't be systemic like it was a couple of years ago. So now we're going to a completely different asset, and this is DAI. DAI is really unique, and it's a bit tricky to talk about, especially to regulators, because of its implications. It has enormous implications that people aren't even aware of. And essentially, it enables you or anyone that's holding crypto to print US dollars outside of the Federal Reserve System. So you can essentially print your own fiat currency and do it without permission of the authorities or the regulators. In addition to that, it enables you to even create a loan to yourself in some ways. And so how it works is you have to provide a crypto asset as collateral. Initially, it was Ethereum. So if you wanted 100 DAI, which represents 100 US dollars, then you'd need $200 in Ethereum that you put in collateral in a smart contract, and then you receive DAI. So in that sense, say you have crypto assets, a large portion of Ethereum as collateral, you think Ethereum price is going to go up, you don't want to sell it. Now you have the opportunity to get a loan essentially against yourself, although your counterparty is this software smart contract or application. And so you have to put in $2 in ETH, and you receive $1 in DAI, and now you can go and spend dollars somewhere. You might want to convert the DAI to dollars in your bank, something like that, but at least you can use it. Now it's multi-collateralized. I don't know how many assets, but it's maybe 10, 20 different assets. The second one that came after Ethereum was BAT, basic attention token. And so you can add different assets to collateralizing mint the DAI, and it's not backed so it's not backed 200%. So it's between 140 to 170%. And the reason why is initially they were very concerned about the strength of the ecosystem. So they wanted to add buffers in case, Ethereum just dropped like a rocket. If Ethereum dropped 80% within a few minutes, then this network would be in a lot of trouble. And so because there's a lot more liquidity in the Ethereum network, it's as a protocol, it's much, much larger. It can handle a lot more transactions now, and so they're in a little bit better position. And so the biggest concern is really those one-off, what I like to call black swan events. If Ethereum dropped 80% in a few minutes or in a few hours. I think it'd be impossible for it to do it in a few minutes, but if it had a systemic collapse, which I'm not sure what could cause that at this point, but it would have to be pretty epic. Even in March 2020, Bitcoin dropped from $10,000 to $3,500, but it took a little bit of time to do that. It took a few hours for that to unwind. And so, over a few hour period, that's enough for transactions to get submitted on chain, to unwind, to sell the collateral, to essentially liquidate, for the algorithm to work. as intended. But it does cause these cascading events. And as you can see, both with Tether and with DAI, that their values haven't always been pegged. So Tether dropped to 88 cents when it's meant to be about $1. And that is because Bitfinex got hacked, and there was a lot of questions whether it was backed one for one. And so it kind of lost that peg for a few days. Same thing with DAI. This was in March 2020 during the COVID event. Essentially, interestingly, a lot of, so what happened was a lot of people exited Bitcoin and Ethereum and bought stablecoins. They were moving into some a national currency so that they weren't losing the value of the asset depreciating. And so that pushed DAI up over $1, and it became $1.11. And so looking at discounts or premiums on stablecoins help as well. If everyone is buying crypto with their stablecoins, then the stablecoin might have a discount to $1. You know, the stablecoin might be 99 cents or 98 cents. But if everyone is exiting the market, everyone is exiting Bitcoin, exiting Ethereum, they are wanting to buy dollars, they might exit into a stable coin, then there might be a premium on stable coins. So stable coin might be $1.01, $1.02. And that's because everyone's selling their Bitcoin for the stable coins, for the Tether. And so there are some indicators that you can use looking at stable coins to identify whether they're going, you know, which direction the market as a whole is going. So these are the stable coins on DASSET. Most of them are, well, I guess it's a mix. So NZD stablecoin that is backed by New Zealand dollars and with a custodian, a bank here in New Zealand. Terra USD is more of a digital asset-backed token, so it's algorithmic. Tether has assets all over the world. True USD is out of the US and has assets with custodians physically in the US, same with USD coin. And then wrapped Bitcoin, WBTC, where one wrapped Bitcoin equals one Bitcoin in theory. And so, so we do have a number of different stable coins that you can trade against or exit out of or exit into. And of course, one of the biggest benefits is the ability to transfer from one jurisdiction to another, or from one country to another. And so it's lower fees. You can exit at 4 a.m. from an exchange into Tether and send that Tether from one exchange to another. And the fee is whatever the on-chain transaction is. You don't have to call your bank, wait Monday through Friday, 9 to 5, and pay, you know, that international fee and wait a few days. So in some ways, these systems are seen as settlement networks that compete with the likes of SWIFT. So let's open it up to questions.
Thanks, Stephen. One question, we do have a few questions. Is stablecoin protected against inflation?
So yeah, that's a great question. And that's, I think, where the debate and question as to what stable means, because they say, you know, if you think about the initial or original definition of a stable coin, where what it means is one digital token is pegged to $1. And so dollars are more stable, less volatile on a day-to-day basis than crypto. And so that is where the idea of the value being stable would be. But if you look at dollars over the last 10 years, you know, dollars have lost 50% of the value. The last 2 years, dollars have lost 20 to 40% of the value. And so if you, so that stable coin that's pegged to $1, will always equal $1. But if you peg it to, if you do peg it to, over time, then it's losing that value. And so, so over a long period, are stable coins stable? Well, yeah, from a peg perspective, but are they going to retain their value? Maybe if it's a gold-backed stable coin, but they're not really going to lose their maintain their value long term.
Thank you for that. Is a CBDC an analogy of stablecoin? And for those who aren't familiar of CBDC, that's a central bank digital currency.
So that's a really interesting one because I don't know what's going to happen. The interesting thing about, so I have a couple theories, and a digital token that is a stable coin means that it's not always, but the traditional meaning means that's backed by a physical dollar. So right now, a dollar in a bank. And so that means that the bank has a dollar there sitting there that represents this digital form. But a CBDC, a central bank digital currency, doesn't have that physical backing. It is the principle. It is the token that is legal tender and authorized by the state. And so if that's the case, then it is slightly different. And so it removes that need for custody. And then it comes down to, you don't have faith that is backed one for one. You have faith that this dollar actually has any value, and you have to question that faith when they're printing enormous amounts of that paper. And so my theory is that today we are creating digital tokens that represent physical assets. We're creating digital tokens that represent paper. So one digital token equals $1. I think in the future, the opposite is going to happen. We're going to be creating pieces of paper that represent a digital token. So the digital token is the thing that has the value, and the piece of paper is the representation of that digital token. And so I think probably in 10, 15 years, we'll see the complete opposite happen, where the paper is the representation or the derivative rather than the digital.
That's quite interesting notion, actually. As you mentioned, I think earlier as well, stablecoin can be mined, right?
Some, but not like Tether, no. So some algorithmic stablecoins exist in this way, where they can be mined for by providing collateral or providing liquidity to that network. And so I don't really go into too much detail behind these tokens, but basically the more liquidity, the more collateral that's backing that token, there might be a slight premium for a number of different reasons, but some of it is arbitrage between different markets. There's so many different markets out there that some of these are giving premiums of 3, 5, 10%. And these are maybe profitable short term, but long term they're risky because they're not going to be a million of them, and they're trying to issue millions, not millions, but there's lots of them being issued, so there's a lot of competition, and some of them will collapse at some point because they require that network effect, that need for liquidity, and they won't be able to maintain that. So there are some great opportunities to make some money providing liquidity mining for some of these, but I think they're going to get narrowed in the quantity of viable ones long term.
I see. Thank you for that. And one last question. You did mention NZDs. Does DASSET have a market for them or liquidity for that?
Yep, so we have NZDs Bitcoin market. It is managed by the issuer, so that is done by Tekami Mint, and they have added liquidity to the platform. You can trade against NZDs, and I think they just got into one DeFi protocol recently. So eventually you'll be able to get loans against NZDs, that kind of stuff.
Oh, exciting. Thank you for that, Stephen. And that's all we have for today. Thank you so much for everyone for joining our lunch break and to talk about crypto journey. We do appreciate you tuning in and hope you learn a little bit about crypto and stablecoins. If you're interested in any topic you'd like for us to cover in one of these lunch sessions, please let us know. Drop us a message in our social media or support team. And before we sign up, I'd like to remind everyone that our crypto journey is held every Thursday at 12:30 during your lunch hour. So we'll see you next week. And any last words, Stephen?
Nope, thank you so much for attending, and looking forward to the next one.